Welcome everyone to Bright Returns, powering business growth with expiring solar incentives. Today we're going to discuss on-site solar as a strategic operational investment, and it's a timely conversation as we see the confluence of ever-rising energy rates in Ohio and across the country, all while the solar investment tax credit is sunsetting in different phases over the next few years. My name is Chris Seguin. I'm a business development manager with Melink Solar. I'm going to be acting as both MC and part-time presenter today. I'm joined by Adam Titus, CPA, shareholder, and board member from Brady Ware, a regional accounting firm working with businesses like you all, as well as Marvin Cunningham, the president of Long-Stanton Manufacturing, a metal stamping and fabrication company almost 200 years old, based out of Westchester, Ohio. This is a short session, only about 30 minutes. We're intending to provide you what you need to know and the why and how of how you get a solar project done at your business. We're going to open it up towards the end for about 15 minutes of Q&A. I want to get into a few housekeeping items before I turn it over to Marvin to get going. So audience mics will be muted throughout this presentation, but please use the Q&A section within your Zoom there to input questions. We'll do our best to get to them as they pop up, or we'll save them for the end. Please go ahead and engage. We're going to have 2 polling questions to help get to know you all as the audience throughout this. We'll have presenter contact information available at the end for any follow-up questions in case you need to hop at the 12:30 mark. And finally, as we heard up top, this session is being recorded. It's going to be made available to all the attendees as well as available on Brady Ware's YouTube page. So without further ado, let me kick it on over to Marvin Cunningham, president of Long-Stanton Manufacturing, to get us going.
All right, everyone. Thanks very much for joining us. Like Chris said, I'm Marvin Cunningham with Long-Stanton Manufacturing. We're a metal stamper and fabricator located in Hamilton, Ohio. We've been around since 1835, and this is kind of a little bit of what we did to kind of start our sustainability and the kind of solar journey. As we get started here, I think we're going to have a poll question real quick for you guys just to see where everyone's at with their experience with solar. Just real quick, if you wouldn't mind answering this question, have you ever investigated solar installations? And it'll take about 5-10 seconds, and then we'll show the results so we know where everyone's at. All right, I think. What is that? All right, looks like we have a good balance here. Some people never, some people a few years ago, within the last year, and looked at it multiple times. Excellent. We'll go ahead on here and move on to our first slide. So we got into this basically we looked previously in 2018, 2019, when we needed a new roof for our first facility, our major plant here in Westchester. At the time, the math started to look okay until we signed our next 3-year power agreement, in which case the cost of electricity was going down significantly for us. So fast forward right before COVID, we're taking a look at this again, and we weren't quite sure. COVID hit. But 2 years later, our power purchase agreement was up, and we were looking at a 42% increase in our next power purchase agreement. At the same time as it happened, Melink was putting on a seminar, and I attended and started kind of having a conversation with them. And coming out of that, I talked with our CFO, and we're like, man, this might make sense. At the same time, the Inflation Reduction Act had passed, the month before. And we started stacking up all these different incentives and the cost. And basically, within a few months, after talking with our owner, who is an electrical engineer by background, so we had a lot of questions about how does this really work? Is the warranty good? How's this going to integrate with our electrical system, which he knew because he'd installed some of it. So once we got past that point, we kind of got started with it. In addition, there were some soft benefits. We have a number of customers in Europe, Fortune 100 and 500 companies that are interested in what are you doing carbon credit wise or carbon reduction, energy efficiency. In the US, that really hadn't started hitting yet, although maybe a little bit more now. And then as for us, we've been around for a long time. So when we buy a piece of equipment, we're looking at not just this year, next year, but 5 or 10, 20 years out. And at the time we decided to go with the solar, we were looking at, everything kind of like Maslow, Hyloff. You need a building, you need employees, right? But we're going to need power. So rather than choosing like a piece of equipment that we might run for a while, but then if we lost a job, we might not run as much. We knew we would need electricity for everything. This is one of the things that kind of pushed us towards that, and looking at how we can keep the cost of energy lower long term. We locked in more or less our rate. It's somewhere along the range of all in of like 1.5 to 2 cents per kilowatt hour for the next 25 years. Now, our system covers about 85% of our usage in this building. Um, our hope and what we kind of plan to do is even while we grow is as we replace equipment machinery, or for example, LED light bulbs, what have you, is we're trying to bring it so we can cover 100% over a given year. But we left about 15% on the table for us to try to get through energy efficiency going forward versus just a straight solar investment. That also made a lot of sense too, because in the summer we have a lot more demand for air conditioning and everything else like that. But in the winter, you have less production. So we basically overproduce in the summer, but we get a credit on our utility bill. I just checked earlier today, and right now we have not had sorry, look at it again. We've not had an electrical bill since our last one was in March and was a couple $100. And as of right now, we have about a $1,900 credit that we're still negative on our electric bill. And I'm guessing sometime in November, December, we'll start to pay a little bit for power in the winter months. All right, kind of moving on a little bit. The process that we went through and everything was multi-step. So I mentioned that we talked with our father, he's an electrical engineer. But when we started looking at it, we could see this building here. We've added onto it 5 times. So there was some structural issues we had to look at. On the left, this was kind of the initial plan, was closer to 90%. But when we got into it, we found that, oh, well, there used to be a crane here and you can't put solar in this area or for other reasons. So we changed it around a little bit based on the limitations of what the building could hold. We'd also initially planned to do a system that is weighted down, like called a ballast system with concrete blocks holding it in place. And we ended up going with a system that actually mounts directly to the roof to reduce the weight of the system. In our other building, which in the after analysis, you can see, which we've now done another solar project on as well last year, that one needed a new roof. And so we tried to we did roll in energy credits for that as well, because if you're replacing the roof as part of the structure at the same time as you're doing a solar project, we were able to get tax credit on the portion of the roof being used for the solar. In our case, it's the southern part of that roof. And so we were able to take a tax credit for the roof part of it as well. As that project, we had to swap out 2 meters. It was a little bit more detailed because we had 2 meters in the building. We had to combine them together because Duke only lets you have it going to 1 meter. Ideally, we would be able to put more stuff on that roof and power both buildings and get to 100% that way. But you're only allowed to use like 1 meter hooked up to a solar system at a time. You can't have it across multiple meters or locations. Let's see here. After that, yep. So this is a picture, kind of gives you an idea. The installation was in December. That's when they switched out our meter. They made some mistakes with our bill, but that all got sorted out once the meter switched over. The system came online, and then in January, and you can see the kind of the cost going down there. And in early April, we got this is our first negative electrical bill. We still have gas charges on here. We shut off gas every year in April and then turn it back on again in October. So over the summer, we were basically getting negative bills. But when we turn on the gas, like right now, our gas will be turned back on, I think, in 2 weeks. The credit we've built up with Duke will pay for both gas and electric until we basically run through that credit sometime in November, early December. But gives you an idea of how net metering has worked for us. And this is just another way of looking at here our historical energy bill 2021 into 2022 and then 24 into 25. You will see a little bump in September. There should be more of a bell curve going kind of down below the gradient, but we did have an issue. Our building got hit by lightning in late August, early September, and so one of the inverters we had to get replaced. It was under warranty, but that got whacked. We've had our building hit several times over the years. It's just one of those things. Insurance wise, we didn't have any kind of problem or anything like that. Other than that, yep, more or less 30. We're looking at it as a 30-year kind of a program at a rate of right around 2 cents, a tiny bit below per kilowatt hour, versus we were paying 12 in total to do with both delivery and power usage. And then now, of course, the last few years, energy costs have gone up even more, and they've barely affected us. Risk management, of course, that's like changes in energy costs, but also we look at it as like if our competitors don't do something like this, and we get another 2008 when everyone's like really barely hanging on, it's going to, if we're in the summer and money's coming in from the power company, it might give me the ability to go in and like maybe buy their business or do something else, like or keep our cost structure low. And to a certain degree, it's a soft cost, but or soft benefit, but younger people are more interested in, what are you doing sustainability wise, and are more interested in working for a company that does things in that area. And right now, I don't know about you guys, but we're always having a hard time finding not just talent, but qualified talent. We can get people through a temp agency, but they're really not qualified. We need people that are interested in making a career out of manufacturing. And this helps kind of attract some of the, I'd say 25 and less kind of crowd, a lot more so than, maybe the 55 to 60 crowd. Yep. And some takeaways here, grid cost, and in my opinion, and what's seen in the last few years is it's going to keep going up and up. AI was really not, on my radar or anyone's radar back when we kind of made a decision to do that. But when I look at what our customers are doing with it, what we're doing with it here, I think electricity costs are really going to continue to go up quite a bit, and this helps insulate us from it. It made a lot of financial sense for us there. Adam will probably cover that a lot more, so I didn't talk about it, but for us, it was extremely beneficial. In addition, SRECs, which allow you to sell your credits. We didn't put that in our plan for either one of our buildings, but we are now getting approximately $12,000 a year through selling the credits from producing the clean energy in Pennsylvania, which was it's just an added bonus, and has helped us, even more pay for the investment we made. Yep, and yeah, the tax credits are expiring, so it's for us. We looked at it as like a 30% off coupon. Bonus depreciation worked a lot for us as well. It's even better this year than it was before. And yep, that's if you guys are interested in doing it now, it's definitely the time to do it.
Awesome. Thanks, Marvin.
Yeah.
Melink Solar has been very proud to work with you guys, your whole team here, and not only complete the projects, but celebrate those projects that are helping drive your business growth. So, gang, as we saw, Marvin's team first considered solar a while back there, ran through the numbers, and then that driver really came back because of the rising energy rates they saw coming down the pike with their third-party supplier. So I'm going to go into a little bit more detail of what we're seeing in energy markets now and what's expected with some data from different financial institutions as well as energy industry experts. First, just give you a quick look at commercial energy rates in Ohio and across the country over time here. This graph tells us really two major points in that over time, the cost of electricity goes up, right? And that tracking and predicting and planning for those rate increases can produce an operational nightmare and headaches to actually consider your month-to-month, year-to-year bottom line. We all saw what happened in Ohio last year, or pardon me, last summer here in June. We saw the rate increases coming. You see on the left here, PUCO's price to compare graphic showing all the investor-owned utilities across the state. That auction price from the PJM capacity auction really drove that. We'll talk a little bit more here. That took place in July 2024, and we saw an 800% increase year over year from the year prior. But capacity is not really the only concern driving energy rates up. Marvin just mentioned AI, what kind of slapped us all in the face. Remember that investor-owned utilities have been submitting these rate increase requests to PUCO over the past few years because they need to help pay for these long overdue infrastructure updates. Ultimately, these are IOUs, they're investor-owned. They don't want to be taken out of their profits and what they're reporting each quarter, so they pass those costs along to us, the ratepayers. Now here we see a little bit more of what happened with that PJM capacity auction. And like I said, from 2023 into 2024, we saw an 800% increase. Now this past July, we saw a clearing price at $16.1 billion. It's only a 22% increase from the year prior, but that's because FERC placed a 2-year cap and floor on this capacity auction. This one hit that cap. Next year's expected to hit that cap. And folks in DC and across this territory are still looking at what's going to happen beyond that. But like we said, it's not just capacity here. So taking a look at the Energy Information Administration's predictions, we see for transmission and distribution, an average of about 3.4% average annual increase over the next 5 years here, because we know that the grid is old. On average, the US transmission infrastructure is at least 40 years old. So simply put, it's outdated and it's not meeting the needs of our current energy situation here in Ohio or across the country. How does the market react to this? Well, I took a look here at PJM Energy Futures, looking at Q4 of this year all the way through 2029 to understand that. We see that those prices are going up over the next 5 years on average 8% each year. So what does that tell us? Well, if market participants like large energy buyers or institutional investors are buying at these prices, then we know that they're predicting the sustained energy cost increase that's going to be greater than that 8% each year. And what else impacts these grid costs? There's a laundry list of different factors that influence energy costs in our country. We've hit on a few of these like grid age and need to upgrade, AI driving all of that demand up. But ultimately, all of these in the list here drive to that point of overall energy market volatility that makes it very, very difficult to manage your own P&L. So tying it all together here, take a look at some data that comes from NextEra Energy, who's the largest owner of energy assets in the country. On the left, we see a story that we all should know by now. Our country's future energy demand is not like it's been in history, mostly due to AI. This demand and those predictions see that sharp upward trend over the next several decades. Now, how do we meet that demand? Well, different generation sources are coming online, but not all are the same. The fastest way to get new electrons onto the grid is going to come from new renewable energy generation from wind and solar. So you add these two on the left together to get our final piece here on the right. And that's looking at that long-term cost of an energy produced for you at your facility. Due to the cost and the time that it takes to develop natural gas and nuclear generation sources, wind and solar are going to provide that lowest long-term cost for their energy produced over the lifetime of that source. So what do you need to take away as a manufacturing leader here in Ohio right now? Consider your exposure to a volatile energy market and how it impacts your long-term planning. Know that you have options beyond the utilities alone, and that your business shouldn't be paying for these updates that they have ignored. You can lock in your energy price for the next 30 years with solar, and that means risk management for your business. All in, an investment in solar is not just an ESG choice anymore. It's a leadership choice for businesses that are planning long-term and looking to grow. So now, like with all investments, you need to consider tax implications, how it's going to impact your books. So let me go ahead and pass it on over to Adam to discuss how the big, beautiful bill impacted solar project economics.
Thanks, Chris. As Chris mentioned at the start, my name's Adam Titus. I'm a shareholder with Brady Ware. We're a regional public accounting firm, and I also lead our tax practice. And so, Marvin went through a great example of how solar made sense for his business. And Chris covered some great data there on just rising energy costs and how that's impacting decisions like deciding on a solar project. So what I'm covering here is the last piece is really talking through the investment tax credit, which Marvin mentioned that he was able to claim on his project, and some other tax related items that can really help to reduce the cost of that investment up front, in addition to the energy savings on the generation that you're getting over time. So the investment tax credits under Section 48 of the code. I think that's the only time I reference code sections in here, so I try not to bore you too much with code sections. But it's basically a 30% tax credit on the installed cost of solar energy equipment. So as far as what's considered installed costs, I mean that's the equipment itself, the construction, engineering, electrical and structural work to support the system. It's all kind of captured in that. And as Marvin mentioned earlier, on his project, there were some roof repairs that were needed anyway. And depending on, what materials you use, you may be able to capture those expenses that you would have had regardless of the project. If they're more reflective materials that increase, the energy captured by the solar array, then, that could certainly increase that cost and push up that credit amount. And that credit is claimed on the year that the system is placed in service. And so that means that it's operational and generating electricity. And that's also, even though you're taking a credit on it, the equipment's also eligible for bonus depreciation. And not just the equipment itself, because typically you would capitalize the entire cost of the project, and you're able to expense that. And I'm going to cover in a little bit what percentage. And then, lastly here on this slide, who can claim it? Corporations, either an S corp or a C corp, partnerships, sole proprietors, in other tax information reporting types can even claim it. A little bit different process there, but there's opportunity to claim it regardless of how your entity is structured from a tax standpoint. So I mentioned on the previous slide that it's eligible for bonus depreciation. And the big thing here is that the OBBBA, the One Big Beautiful Bill Act, that was signed into law on July 4th of 2025, made the 100% bonus, first year bonus depreciation permanent going forward. So absent any legislation in the future to wipe this out, you're able to take 100% of assets placed in service, after January 19th, 2025. So just to, the quick math here on an example. So, the investment tax credit, which we talked through on the previous slide at 30%, and just, for simple math example purposes, use the cost of 500,000 on installation. 30% of 500,000 is 150,000. And then the bonus depreciation is calculated by reducing the cost of 500,000 by half of the credit. So even though you're getting a full credit, which is a dollar for dollar reduction in the tax that you owe, you only have to reduce your cost by 75,000, half of the credit. So you're deducting, basically 75,000 is, part of the credit that you've already received a tax benefit for. So, your deductible portion of the solar project would be 425,000. So we're going to go into some examples of, what that means from a tax standpoint. And on the first slide here, we just have the example involving a C corp. So just trying to cover, different entity types. And if we just assume, net income, assuming, this is after any other like tax adjustments, to make it very simple, $2 million. So there's no bonus depreciation with no projects, on that left-hand side of the slide. Tax at 21% on that would be 420,000. On the right side, with a solar project, same net income of $2 million. That bonus depreciation previously calculated on the other slide, the 500,000 less the 75,000 for half of the investment tax credits takes 425,000 off of your taxable income to get to the net 1.575 million in taxable income. So if we take again the 21% rate times that 1,575,000, you get 330,750 in tax. But then, we can't forget about the investment tax credit. The 30% of the original 500,000 of 150,000 comes straight off of that tax due for a net tax due of 180,750. So if you compare the bottom line on the left slide and the right side of the slide, you have a tax savings of 239,250. So it's that's almost half the project cost in tax savings on that first year. So on the next slide here, we're just covering basically the top individual rate. So I'm not going to walk through it, line by line. it's laid out very similarly, but the top individual rate is 37%. So if your entity is a pass-through entity, either through a partnership or an S corp that you hold your business in, or if you're a sole proprietor, it's included on Schedule C of your return. This would be the top rate that you'd be subject to at 37%. And so the net tax difference, on that previous slide, 740,000 versus 437,750, the tax savings grows to over 300,000, roughly 302,000 in tax savings. So I've covered, the credit, bonus depreciation, and usually the question is, well, how do we claim the credit? So, you go through the entire process of the project and reaches completion. It's installed and placed in service prior to the expiration of the credit. And I'll cover those expirations here in a minute. And generally, you're going to provide all, the documents related to the project to your tax preparer. That's going to be, all invoices, total cost, inclusive, to make sure that we're capturing everything from that documentation. And then it's fairly simple from that point. Form 3468, we document all the information, fill out the applicable lines on that form, and that form is what calculates that 30% credit. And if you're a C corp, it would be claimed on the C corp return. If it's a pass-through entity, it would flow through the entity to you as an individual, and you would claim that credit on your individual tax return. So with that, we'll cover some updates here related to the One Big Beautiful Bill Act, which I talked a little bit earlier. It was signed into law on July 4th, 2025. So prior to this bill, the phase out was not, as far as the credit reducing or being eliminated, was not, going to occur until 2034. And then this bill terminates the credit for solar facilities that are placed in service after December 31st, 2027, with an exception for facilities that begin construction on or before the date that is 12 months following the date of the Act's enactment. So July 4th, 2026. So you would have to start construction prior to July 4th, 2026, or if you start construction after that, finish the project and have it placed in service prior to December 31st, 27. So solar projects that begin construction in 2025, so within that 1 year, would need to be placed in service before the end of 2029. And solar projects that begin construction after 2025, but on or before July 4th, 2026, have until the end of 2030. And then I mentioned this, but the projects beginning construction after July 4th would need to be placed in service before the end of 2027. So that's a very tight window. If you're not, starting construction prior to July 4th, 2025, you basically have 3 years cut, 2 or 3 years, or I'm sorry, 2 or 3 years cut off of your time window. So there's definitely some urgency there to get the project started. And next slide, we're going to cover what that means. So I mentioned earlier, I don't have any more references to code sections, but I do have a few Internal Revenue Service notices that have been posted by the Treasury Department. The first one's notice 2018-59, and it covers basically the safe harbor. So what does it mean that construction has began? And there's basically a two-part test there where physical work of a significant nature has started, or meeting the so-called 5% safe harbor test. So that's incurring 5% or more of the total cost of the project in the year that construction begins. And both methods require that the taxpayer makes continuous progress towards the project completion. So you can't just start it and then not do anything else. There has to be, continuous construction. Then we have the notice that was posted this year, 2025-42, which generally eliminates the 5% safe harbor test, but I want to pause there because it's only for solar facilities with a maximum net output of no more than 1.5 megawatts. And, in working with Melink and discussing what their typical project size is, it's generally around that, 1 megawatt, or, generally below 1.5 megawatts. So that safe harbor of 5% is still there. So there's always the option to, kind of get the project rolling, iron out the details as you're moving so that you're, beginning that construction and allowing yourself the time in the remaining window to claim the credit. So just as we have, manufacturing businesses in the room, I just wanted to cover, one additional item that was a pretty significant change in the One Big Beautiful Bill Act. Like I talked earlier about 100% bonus depreciation, maybe becoming 100% permanent, and that's for equipment, personal property. But there's a new elective 100% depreciation allowance for qualified production property, and that's allowed for construction beginning after January 19, 2025. And that qualified production activity includes the manufacturing of tangible personal property, agricultural production, chemical production, or refining. And so this is a fairly, new concept that it's basically allowing for the deduction of real property. So a building itself that is used in manufacturing. And that doesn't include any, part of the building that would be used for offices, administrative services, lodging, parking, sales activities, research activities, all those items you'd have to carve out as far as the square footage, related to those areas versus, the manufacturing area. But basically the result of that is it becomes deductible 100% in the first year versus potentially spreading it out over 39 years or 15 years. Now, with this being somewhat, very new and somewhat unusual, there's, we're waiting and pending guidance to come out to better define what they're truly after here. Which we'll be studying that and getting out some additional information on it. But the bill did have basically a 1-year target to get that the Treasury regulations out on this part of the bill. So we should see that, within the next year. That's all I have.
Thank you, Adam. Appreciate it. We know that the Big Beautiful Bill very much manufacturer heavy. A lot of different opportunities for folks here on the call today to discuss different strategies. Adam and his team definitely available for you guys to chat through different things here. So I know we're a little bit over time. Want to quickly kind of wrap up with something that's important. If you're sitting on this call here, you answer the polling up front. Maybe you haven't looked at solar. Maybe it's time to look at it again. What does it look like for you today? So we put together a sample for an Ohio manufacturer with a system here that is going to cover just shy of 60% of their annual energy needs. And that comes in with that installed cost that Adam was talking about at $1 million. Looking at, again, a 21% C Corp tax rate there, brings you to a year 2 outlay after those incentives of $450,899. So under half the cost of that upfront investment. Now, what about some of those other financial metrics that you're probably using to consider a CapEx spend like this? So this system's going to save this manufacturer almost $4 million over that lifetime of the solar system, 30 years. Gets paid off in under 7 years and provides an IRR of 15.6% with over a double of the upfront investment on the MPV side. Now, remember, that is a C Corp tax at the 21% there. So if you are another entity type like Adam was talking about, you should expect larger incentives there and even better financial metrics. Now, finally, to kind of tie together here timelines, Adam's talking about the different ways that you can secure that tax credit. Take a look here at a typical project timeline, all the way from development, those early stage conversations, to commissioning and celebrating your project once it's complete. July 2026 may seem far off for folks, but really the emphasis now is that the time's now to start looking at this if you haven't already, or to revisit it if you've looked at it in the past. You want to be able to complete everything, work your way through utility interconnection processes and all of the design work up front, and meet those tax incentive deadlines so that you can take control of your energy costs. So thanks everybody here. We've got one kind of final follow-up polling question to understand a little bit more about has this changed your opinion? Why would you even look at solar for your business? So we're curious to understand what's that number one factor for your company to potentially opt for solar as a strategic process there. Options on the screen giving us lower electricity bills, risk mitigation through more stable energy costs, tax benefits and incentives, carbon reduction, or your brand reputation. Give it a couple seconds here to let everybody answer and read off the results. Okay, we can go ahead and close it and see what we've got. Curious if anybody's changed. So 13% of you said lower electricity bills, a quarter, 25% said risk mitigation through more stable energy costs. 38% are considering these tax benefits and incentives and thinking about where we're going here in the future. 25% giving us carbon reduction, and nobody was looking at brand reputation. So we'll be very curious to understand, if today's session changed anybody's opinions, made you think about this investment as a different way. Again, we're over time. We want to thank everybody that's hung around here. We look like we've got a few questions that have come in throughout the discussion. Adam, Marvin, myself are going to be hanging around here to help answer some of those. But if you need a hop, please take note here of the contact information. If you're looking to have a discussion about solar, reach out to me. If you're looking for the tax information and how your business can plan, reach out to Adam. And then if you're looking to understand what it means for you as a manufacturer, what a person in your shoes has experience with that, Marvin's always willing to talk about his 2 projects completed at Long-Stanton. Let's go ahead here and see if I can get into the Q&A and see what we've got there. So Marvin, it looks like you did send an answer out, but want to go in and get an understanding, let everybody else hear. Can you share a little bit more about how you decided to finance the system? Was it through a line of credit? Was it a loan? Was it a cash payment? What'd you guys do?
For our first system, we ended up going with a 5-year loan. If memory serves, the payback on that was estimated to be around 4.6 years. So it made sense. We oftentimes, if we're using finance, try to finance in the period that the payoff would be. We'll end up doing better than that because of the SRECs, but it's a 5-year note. So we'll be done paying for that in January, basically 2.5 years. The other one is a little bit smaller size system on our other building, but we ended up financing that out of cash flow. There's a series of, you have a down payment, after there's payments due after the electrical drawings are finished, stages throughout construction. And so we were in the position to be able to just pay for that out of cash flow. So we did it for the second project that way.
Awesome. See another one here. Another one for Marvin. Curious, as you look at this as a business owner there and president of the company, what does operations and maintenance look like for you guys? You mentioned this is a long-term, kind of like a building project. What is operations and maintenance for your solar system?
So far, it's been pretty minimal. The biggest thing that we've had to do is once we had an issue with in the spring, there's a lot of like fluff around here. I'm not sure what kind of plant it is, but it kind of gets in our air compressors. We have to clean them out. There and the inverters we have, I think it's 2 in this building and 1 on the other building. They have like a little fan. So we have a maintenance thing in our ERP system that every spring and every fall we go and just clean off the filter. It takes all of 30 seconds. It takes longer to get the email and do it. But other than that, it's really been like I have an app that comes with the system. And so I check it, today's a sunny day. I've not checked today, but I check quite frequently to see how much production we're making off the system versus how much usage is. And I can see over like 1 month, 3 months, a year, what have you. and kind of compare that. So I keep an eye on it mainly because I'm interested in seeing, how much money we're saving, but also that would tell me if there's an issue with the panels. You can granularly see down to an individual panel if you want to see like if only one of them is like producing 0 watts, then could put in a ticket to get it looked at, but we haven't really had that issue at all.
Great, great. Let's see, got one here for Adam. Somebody must know a little bit about this. Curious to dive a little bit into the bonus credit situation. So those added bonus credits on top of the 30%, are those in the same timeline as the general ITC? And what does that mean for folks looking at a solar investment?
Yeah, so those expirations basically line up with the general expiration of the investment tax credit, but there's really three main bonus credits. There's the domestic content bonus, which is 10 percentage points, up to 10 percentage points. And that the project must use steel, iron, and manufactured products with sufficient U.S. sourcing in order to qualify for that additional 2%. And then there's also the energy community bonus, which is again up to 10%. If the project is located in a qualifying energy community, examples of those would be areas impacted by fossil fuel, industry closures, and coal mining areas. Other examples there, but specific of specific areas. And there's also the low income community and environmental justice bonus, and that's for communities in Indian land or in affordable housing economic benefit projects. And that's 10 to 20 percentage points added under the investment tax credit. So, those can stack. So in the rare case that you have, all three of those apply, your percentage could be upwards of 50 to 60% of the project costs.
Right. For our project we actually had for the low income area where we're happen to be located in a census tract that's low income. But on that one, there's a maximum per year of how many megawatts, I guess it is, that are allowed to apply for. For that specific one, we applied twice actually, because you can go each year rolling forward and apply for your system. And we've applied twice now, and it goes quickly. It's oversubscribed by like 10x. So the 30% one, it's there all the time, but the other ones seem to be like they go very quickly, and it's like a black box. You apply by this date, and then 1 in 10 people get it. So it's kind of like a scratcher. You know what I mean? I wouldn't count on it, but it'd be awesome if you get it.
Yeah,
I think it's the dual limits 1.8 gigawatts. And I think as you mentioned it there, that one you have to, apply for, and it's limited. The investment tax credit, there is no like pre-approval or application process other than just including the form with your return. So it is very straightforward,
Right.
and easy to get once the project's completed.
Yeah, to wrap it all together, how we would propose that within financial analysis from Melink Solar. Adam mentioned energy community. It just depends on where you are. If you've never looked at that, definitely reach out and we can run some, the maps there. You might be surprised that you're in an energy community. If we've got anybody from Northeast Ohio here today, almost everywhere around the Cleveland area except for Cuyahoga County is within an energy community. So you're automatically up to that 40% off. As we look at domestic content, it's always going to be running the numbers there and understanding that higher upfront cost for US made equipment and that net cost with the 10%. And so as markets fluctuate and change, that might make sense, it might not. I want to emphasize that the threshold requirement for the amount of US made materials goes up in 2026. So it's going to mean you got to pay more upfront in order to earn that. Another driver of why you want to start looking at things now. Let's see, got another one here for Marvin. Kind of curious about that SREC piece that you mentioned. You said you guys getting checks on that. Could you dive a little bit deeper into what that means and how that's adding to your overall project economics even after these have been completed?
Sure. With SREX, so when we first did the program, it was like something that existed, but we didn't spend a lot of time looking at it. And to be honest, within the first year even of having the initial solar system, it was like on our back burner list to look at. But we got, I think I reached out to South Monica, and they got us in touch with a company called Soul Systems based in, I do believe it's in Pennsylvania. Ohio used to have a very, I guess, robust ex-rec market a few years ago, when there's a whole scandal around nuclear power and all that, and they changed that House bill, whatever it was, that wiped most of that market out. But because we're part of PMJ, we can also sell our SRECs in Pennsylvania, which is what we opted to do. There's a lot of different options for it. We decided to sell basically locked in 3 years. So everything we produce for 3 years will be sold, and it's something like 10 or 15% below what today's market, or when we did it in April, that day's market was basically. I want to say it was like $31 or $32 megawatt hour, and we sold ours for like 28.50 or something. But we got it locked in for 3 years, not really knowing where that's going. I have not looked to see if that was a good bet or not. I've heard tell of people that go and just sell all 15, like 15 years worth. I think as far as out as you can go. And if you were to do that nowadays, and with bonus depreciation, with the things, you might get to the point where you have almost the entire project paid for. I think on a $500,000 project, you might get as much as $150,000 upfront cash as part of those contracts. But you'd have to look into it specifically for, your area and what's going on right now.
Yeah, I think then take the last question here, as we're definitely over time, but to tie that all together, somebody asked, well, what does Melink Solar need for a quote? Marvin just kind of touched on, there's a lot of different factors that can influence the ultimate financial analysis. This is what you'll look at as a leader to decide yes, no on a decision to move forward with solar. For the start here, just to get an understanding of what we would need, we need 12 months of your electric bills. 12 months of your electric bill, so we can get an understanding of what your energy usage is, what you're paying. It can model that within our financial software. And a quick chat to understand, where you're looking for solar, what are your goals? Do you have a percentage offset that you need? Do you have a budget you need to stay under? Why do we want to go solar? Melink's been around for 15 years doing this work as the largest commercial engineering procurement construction firm within Ohio and the Midwest. And happy to go ahead and help you guys with a seamless process from that early stage exploration all the way through working with folks like Marvin and Adam here, celebrating their solar, getting folks out there and talking about it and what it meant to their business. So with that here, again, see the contact information on the screen. Please feel free to reach out. Anybody looking for information about any of these topics that we discussed, we're all happy to discuss it further with you. Anybody looking for a quote that mentioned that they've looked in the past, please reach out to Melink Solar, either directly to me or on our website there. We'll get in touch here and produce some of those initial designs and feasibility analyses. Thanks, everybody.